I would like to welcome all the speakers, the participants to the ASSOCHAM's National E-Conclave on New Banking. As we know that there is so much of development which is taking place in the country and across the globe on digital banking, internet banking. India, in many ways, is on the frontier of technology and banking. Our own Jam Trinity, I think, is one of the best in the world, where we have combined the Know Your Customer through Aadhaar card, technology through mobile, and banking through the Jan Dhan accounts. So the Jam Trinity is amongst the best. Even otherwise, in internet banking, India has been doing exceedingly well. Much before others did it, the Reserve Bank of India played a very prominent role and set up IDRBT to really lead the country into technology and banking. There has been no slowing down on this marriage between banking and technology. The fintech companies have come up in India and have done exceedingly well. I remember those days very clearly when handheld devices were really an innovation and revolutionary in our country so that the banking could reach the unbanked in the remotest parts of the country. One would have never dreamt then that the migration from handheld devices to Jam Trinity would take place. And then now new frontiers have opened across the world and in India too. Today's National E-Conclave is exactly talking about the next banking revolution that will happen, and we call it the new banking. Today's discussion is organized in the following way. A report has been prepared by PwC, and that report, it's a beautiful report. I'm sure all of you have had a chance to glance through it. It's a short report, easy to read, but has been prepared by PwC, and Sridhar Vegsna will be presenting that report to us. After that, we have a panel of speakers, and I think the best we could get on technology-related fintech issues. We have Shri Sachindranath from Ugru Capital Limited, and then we have Ketan Doshi from PayPoint, and then we have Praveen Khanna from ScoreMe Solutions. Mr. Kannan Murli is going to be also speaking, and he's from the M2P FinTech, and then Gautam Sinha is from LoanTech. We have invited two very special guests to speak to us today. Shri Ajit Pai, he is a distinguished expert at Niti Aayog, handling economics and finance, and he hails from the financial sector. And I thought he would be the best to tell us about his thinking on the new banking. We all know that he is heading the vertical on financial sector in Niti and has been meeting various peoples, conducting seminars and conferences, and is on the frontier on these issues. The last speaker, our chief guest for the day, is Mr. Subhash Chandra Garg. He is the former finance secretary of our country and amongst the leading thinkers on financial matters in our country. We'll then open up the session for question and answers. With this, we have a long agenda today. We have the experts speak to us. We have the policymakers speak to us. With this long agenda and all this expertise that we have today, we are going to benefit from it. So I would now invite Shri Sridhar from PwC to present the report and set the tone for the discussion to follow. Mr. Sridhar, please.
Good afternoon, Mr. Singh. Thank you. Appreciate the opportunity to be here. We're very pleased to release the report today, exploring the neobank challenger bank model in the marketplace. The The world is changing, as you talked about, with the advent of internet banking, mobile banking. Now we're at the next generation, which with challenger banks. And really, there are three different types of challenger banks that we must take cognizance of. It's the traditional incumbent banks who are providing a digital-only bank is one model that is out there in the marketplace. Neobanks, essentially leveraging a large technology platform, brand new capabilities, more focused towards the customer, with products coming in secondly, may not necessarily have the license themselves, but leverage a partnership with a bank. Then the third one would be the adjacent expanders, as we call them. The adjacent expanders are also an important play in the marketplace. They provide an ecosystem, and the ecosystem then leverages different types of capabilities, including a mortgage capability from one bank, a payments capability maybe from someone else, a e-commerce capability yet from another party. So these three are essentially the way we define the challenger banks, neobanks, incumbent digital banks, and the adjacent banks. Why are they important? For many reasons. One, the Gen Z generation, as we call them, does aggregate to obviously the online world, but they don't start their life with necessarily a bank or the universal type of bank. They may start with payments with Google Pay, Phone Pay, or some other types of capabilities. So their financial experience comes from a variety of different experiences, not necessarily the same that all of us may have experienced in our younger days. Second, the MSME marketplace, 29, 30 million odd MSMEs are also leverage the digital capability. They're not necessarily starting the journey with a bank per se. They may be looking for product supply chain at different places. And they're contending with the notion of payments and how to deal with digital payments, how to deal with payments other than cash or check. And that marketplace is important for them, but also it's a new way of being able to get credit. And hence, for the challenge for banks, challenge for traditional players, is how do I reach customers like the Gen Z and the customers who are MSME marketplace who have not been traditionally touched by a bank or an NBFC. The other reason it's important is that the investors are also speaking with investments in this space. We've seen a significant spike in post-COVID, the number of neobanks coming into the marketplace, where there were about 20 odd that used to come in on an annual basis. Now we're seeing more than 70 plus coming into the marketplace. In other markets, whether you look at South Africa, whether you look at the US or UK, and for that matter, China, neobanks have made quite a lot of progress. Have they completely replaced the universal banks? They have not. That said, in those markets, they both seem to coexist. And in many cases, there are partnerships that are formed across the two. Regulatory framework is also changing, and we make note of that in the paper. RBI has had quite a bit of discussion on this topic, but we are seeing digital-only bank licenses in other markets. When will that come to India? That's a big open question. Digital-only virtual bank, as we call it, the boundaries by which you need a physical presence is fundamentally changing. As shown in the pandemic, we no longer need to go and find a store to essentially order our food. We don't need to go to the restaurant to get the experience of the restaurant food. So that experience is fundamentally changing the way that we operate. If you can go move the slide to the third page, please. Thank you. So here, some, as I talked about, the three different types of players. The products offered in these banks is different. And the segments that play into the neobanks is very different. It isn't about serving everyone. It is serving about specific customer segments. In other markets, it may be immigrants. In markets, developed markets, focusing on non-banked individuals, younger population, and figuring out what niche products or what niche segment will the neobank play into becomes a very important aspect. But the fundamental shift is customer first, product second. So who is the customer? Who do I serve? And then determine what capabilities or what products do I make offering. So you may not offer everything, but you offer very specific things. Next slide, please. So the challenge and some of the recommendations is first is customer behavior shift. As we know, the COVID has fundamentally changed that, but there are capabilities in our market like video KYC, digital onboarding. These are fantastic capabilities that in some markets don't exist, and we need to leverage that towards the neobank experience. Rural penetration, security. Security continues to be a challenge, not only for the financial institutions, but for all kinds of segments. Gamification is here to stay. And we need to be respectful that the thought process of younger shoppers is really based on that experience of gamification. Value partnership, as we talked about. What do we recommend? Niche segments, as I said. Ecosystem strategy. This is particularly important for traditional players. Financial education. There's proven that when you're able to educate your customer on financial aspects, the utilization and the amount that they bank with the neobank increases. Next slide, please. So this is just one example that I wanted to show you that's in the paper as well. This is a new ecosystem banking type of capability. This is one. It's serving very specifically MSME market. If this was played in a universal bank, it would look very different, right? You would see a payments capability, you'd see a loan, you'd see different types of trade finance, supply chain, et cetera, et cetera. But here, the client is looking at the capability to be able to say, how do I do my entire business on this one platform? How do I reach what I need through one offering? So how do I manage employees? How do I manage invoicing? How do I manage tax? All within the same umbrella in which I am also doing my financial management. We call this kind of the embedded finance type of capability. So this is the direction of play that we all have to be respectful for. Is it here to stay? Will it change? Yes, we're at the same pivot point that we were with internet banking some decade plus ago, when we didn't know whether internet banking and if that's going to stay or go. Well, here we are. Internet banking has been largely replaced by mobile banking. Now mobile banking is now being disrupted by digital banking or digital only bank type of scenario. So I hope you all have the opportunity to go through the paper. We're there to be able to provide additional information on this and look forward to the conversation today. Mr. Singh.
I must thank you, Mr. Sridhar. This was really very good and very brief, very focused. but it was a very heavy presentation, as you have seen the journey. And this journey is going to be really interesting. And this journey is also going to be technologically very, very strong. India, of course, is ready for this journey because we have the skills. And on technology, we are in a position because the past has shown that we can take the pivotal role. So we are there already. And I think the journey has started, and journey is going to become far more interesting as days go by. I'm aware that the Jandan Jam Trinity, which really came through, what a breakthrough it made in banking penetration in our country. Because of COVID, the digital penetration has also increased manifold. The internet penetration, because of the mobiles, has also increased manifold in the last 18 months. Now, therefore, the country is ready for a takeoff. With this, I invite now Mr. Sachindranath, the Executive Chairman and MD, Ugro Capital Limited, to share his thoughts, please.
Thank you, Singh sir. Thanks for the opportunity. I must say, when we make these statements called neobanks and challenger banks, we should be very clear. These are not banks because there is no regulatory framework in India today. If you are not licensed as a bank, no term as a bank should be attached to an entity. And sir, there is a reason for that. In 1969, when Indira Gandhi nationalized 60% or 70% of Indian banking, and since then, the public trust in bank goes beyond their obvious business model. And that is the reason, sir, when a PMC fails or a Lakshmi Vilas Bank fails, all the deposit holder, while they are only insured up to a 1% sum of their money, stand in front of the government saying, please give me my money back. Because the general belief or the trust with the term bank is that if I put money in something called a bank, no, this money is not going to fail. So we should be very clear that unless the RBI decides to bring digital platform which are using the back end of the bank to provide only a service, we should not use the term bank because it can be very, very risky, because a large population of this country which is underserved, not served, may end up using this digital platform in misbelief that these are banks. So I'm not very sure why RBI is not taking cognizance of this and tightly regulating so-called neobank and digital bank. But simultaneously, I do really appreciate that. So theoretically, if a SBI says YONO is a neobank, there's not a problem because it's an SBI's platform and it has all the capability of doing whatever a neobank can does. But if something else who is not a bank but says I'm a neo and bank, but by the way I'm not a bank, I think it's a risky proposition. But it is in my belief that India's whether it is, and which I only work for SME market now, whether it is as PwC said, whether it's to serve the combined need of an MSME, whether it is to serve the need of an underserved who doesn't have an account, or whether it is need of giving somebody a small consumer or a personal loan, digitization is necessary. Sir, as you rightly said, that Jam Trinity changed it. For MSME market, what we call India Stack 2, which is the Open network, would change it again. Because the one transformative thing which I call tripod of the data, I make this statement all the time whenever I go, that in 3 years time, you would see India's MSME financing reaching at consumer financing level. Today, when we walk in a Chroma store, we can buy an AC or a fridge, get it financed in minute and take it in our car and come back home. And that you will see happening for MSMEs. If you get an order of 50 lakh rupees, he at the point of order would get a financing without much hassle. So we created a platform along in the partnership of GEM and iSpirit. And today we are discounting and purchase order of an Indian Railways in 30 seconds. So the force of digitization is here to stay. I think so. What is most important for digital platform, and I'm refraining from using the term the neobank, the digital platform and their partnership is first. There has to be very superior regulatory framework which have to be brought, wherein anything which relates to payment system, lending, or anything which you can think of has to be under a regulatory supervision. Otherwise, the public trust can be taken for a ride. Number two, the collaboration between for large financial institution and small fintechs has to be accelerated big time. RBI already have one sandbox, and a second sandbox for digital service provider should be used. And third, obviously the market has to adapt, and the infrastructure, what we call the public-private infrastructure around digitization, has to be increased. I think so. This is where we stand. There is large number of innovations around these digital platforms are happening, but somewhere they are all prospering or trying to prosper on the basis of conventional regulations, regulation of BC arrangement, outsourcing arrangement, so on and so forth. So the entire framework of how this would happen is yet not fully thought through. Thank you.
I totally agree with you. Means this is a very valid point and a concern, the regulation part. And yeah, I also agree with you, the use of the term, like we use it in blood bank or gold bank, right? But those are used in a different sense. But once we use the word bank with the financial sector, it suddenly becomes a different connotation and gains respectability. In a way, it gets the assumption gets set in that it has been guaranteed by the Reserve Bank of India. It picks up a word, the aura becomes very strong moment the financial sector picks up the word bank along with it. So I agree with that. And then we have the former finance secretary with us, and we have Ajit Pai today with us. I'm sure they're going to reflect and talk about this. But let's continue and move on and get another viewpoint from Shri Ketan Doshi. He is the MD PayPoint India Network Private Limited. Mr. Doshi, please.
Thank you, sir. Thank you for giving me the opportunity. To my mind, what I see this as a new buzzword. We have seen this. It started people talking about payments, then it went on becoming fintech, and now it is a neobank or a challenger bank or a digital-only bank. So it's a jargon which has come up. So I don't think on the face of it, it is going to be a neobank when we tag our company's name. So neobank again is in the coming in the same pattern. What I see, sir, is neobank sort of pseudo neobank. The government issued a wallet license which was tagged to payments, which also falls under the neobank category. BC model was started in 2005. Sort of neobank. Neobank to me is a wrapper above the bank or a layer above the bank, which offers the same services which a bank is offered in a different environment or a different way. The service delivery of the same banking product is delivered in a different pattern or a way or a medium. So finally, it has to land in a banking on a banking network. It has to land under the regulatory framework, whether it is an NBFC or a payments company or a bank-led co-lending product running on the front through a fintech. So the framework is already there. In fact, I think India was much ahead rolling out the neobank. That time, neobank word, the buzzword was not there. So we started in 2005 with BC model. So what BC model does is it is front-ending for a bank. And today we can see from say around 50-55% of the population, now 97-98% of India has a banking bank accounts in place. So all this over a period of time is already built into our system. It is just that a new word has come up, which is a neobank. So it is the same wine in a new bottle, I would say, sir. And the market definitely is there. As Mr. Sridhar, I somewhere. So what neobank wants to showcase means there are two categories of neobank to me. One is the physical one, the sort of digital to physical one, like the BC models giving ATM services or a banking services at a remote location, which is right now in the new buzzword not getting captured. Which, but the other segment, which is digital only, is a neobank. I'm not sure whether I could. I mean, so to me, the services are already there. The BC is offering services at the front end with a new experience for a customer is already a neobank, or a co-lending fintech partner with some bank is already a neobank, or doing some FLDG product is a neobank. It's just a same wine in new bottle, as I said.
All right, thank you so much. We human race continues to be the human race, but Generation X and Generation this and Generation that is always there. Every 3 months, there's a new mobile phone, and then everybody in the family is up and roaring that now this is the next generation phone.
So the
When
problem is
yes,
every few days down the I mean, we run a wallet company, and people ask me, are you a neobank? If I say yes, he will say, no boss, you are a wallet company, and we run a BC model also. So can I say yes or no? It's a gray area. It depends on the perception of the other guy who thinks it in a separate way. I have to tag myself as a neobank in some website, do some SEO, then it happens then.
about 1100 years ago, there was nothing like a bank. There used to be a money lender. And money lenders find their references even in our epics. Money lender has always been there. There was never something like a bank. 1100 years ago, in Europe, outside the market, there was a bench. This Latin word bank, the meaning is a bench where the money lender used to sit. Now, as you enter the market for trading, you borrow from the bench. On the bench, there is a money lender sitting. You go and do the trading, come back, give him the interest, pay him back the principal, take the profit home. This is how the word bank came. The bank word comes from the word bench. So when the bench got the four walls, I'm sure it was a neobank. When I joined Punjab National Bank in 1983, I could never imagine a business correspondent going to somebody's house. But once the business correspondent came in, it was again a neobank. And once I was in the Reserve Bank and the handhold devices came, it was a neobank. So the word neobank, as it stands in literature today and globally used, is basically not defining one single thing, but is a group of activities on the frontier where the blend of fintech with traditional banking is taking place. So I'm with you and the previous speaker who feel that the word bank is being abused. But as you know, the word bank itself comes from a bench, which is an evolution from there. So I'm not too worried of the abuse of the word bank. Neither am I too worried that what is a new bank. To me, it is a generation of banking as evolution is taking place. And now when we have such financially advanced transaction system where you don't need a brick and mortar branch, but technology helps you do everything that one at my age was used to go and walk into a brick and mortar branch and conduct a transaction. So to that extent, I think it's a generation in banking which is happening. I would now like to invite the next speaker for us, Mr. Praveen Khanna. He is with the Vice President of ScoreMe Solutions. I'd like to really listen to his views. Mr. Praveen Khanna, please.
Thank you so much, sir, and good afternoon, everyone. It's a privilege to be speaking today. I'd like to take a more personal example, sir. I'm a father of a Gen Z daughter. So my daughter typically loves artwork, and she's been downloading several apps which help her in the digital art segment. So she started posting this artwork recently on Instagram, and she was soon connected to people from all across geographies. So she was connected with artists all the way from Japan, US, and in Europe as well. So therefore, it's a personal experience for me observing a Gen Z daughter, sir. They're not shy in reaching out to strangers. They prefer typically short communication. Graphics and design is an absolute must when that communication channel happens. And this cohort is spending almost 35 hours a week on the internet. So I think these are the elements, in my view, that define a neobank. So yes, it's a wrapper over a traditional bank, but in my view, it's likely to make the banking journey more personalized, more digital, and more relatable to the new millennial. That's been my observation. So I think the core model behind any business is that customer is king. And as the behavioral shift happens with the generational change, the new generation, especially observing my own daughter, they'd rather message or tweet rather than pick up the phone. So the phone banking, so the messaging banking is much more preferred channel for them. So that fundamental shift is something that a neobanking could potentially offer to them. The other element is the shorter time spans, sir. Speed, I think, is of essence, and that's the currency for the younger generation. So the millennial currency is time instead of money. And as another speaker had recently said, collaboration between fintechs and the traditional banks, that'll be the driver forward. So those are my broad views, sir.
I agree with you. The generation is moving very fast. And, sometimes I feel the whole banking system that came into existence um, and the modern banking system that we see collecting deposits and then lending and taking care of the risk and also taking care of the maturity pattern of the deposits are generally short term, but lending could be medium to very long term. This whole exercise that the banking system does is very unique. But the banking system that most of us generally use is for transaction purposes. The way you are mentioning, the next generation is using, yes, it's very much transaction based. But as I look at it, and I'm sure this is going to happen in days to come, that technology will play a very prominent role. And I think neobanks or the fintech has a role to play in that. Technology will play a very prominent role in settling KYC as well as lending on long-term basis. So the faceless banking and extending credit without asking you to really come to the bank or to a brick and mortar branch. So I think there's so much more than just transactions that neobanking would get engaged and facilitate over days to come. But let's keep moving further now. And I would now like to invite Kanan Murli. He is the Head Products and Data Engineering Technology, M2P FinTech. Mr. Kanan Murli, please.
Good afternoon, everyone, and thank you for this wonderful opportunity. So I want to add on what Mr. Praveen was mentioning, right? So it is not just about a specific segment of customers or one specific use case that is getting solved by these neobanks, right? There are pockets of unbanked customers or underserved customer needs that is probably giving rise to all these neobanks coming up, right? And so the challenges are not just with one particular segment, right? It is if you are an MSME, what you need is very different from what you need as a Gen Z millennial, right? So there are multiple use cases that these new banking are trying to solve, and each of these is trying to cater to the needs of a niche customer group, right? It is not like what the bank is offering. It is the same solution for all customers. So they are trying to target pockets of customers with very, very specific needs. And that is what they are building their entire technology around, right? So I think, and it is not like the neobanks do not have technological challenges of their own, right? Like we all understand there are different ways in which neobanks are operating. One is they have a partnership with an existing bank, right? So they'll have to ride on the rails of the partnership to explore what opportunities they have within the specific segment that they are catering to, right? So there is again that is good in two ways. One is it gives the guardrails for the actual financial transaction to happen. And it is also a little limiting on the potential of what can be from the neobank standpoint, right? So we as a fintech company sitting in between neobanks as well as the traditional banks, right? So what we as a company we provide, we are able to see both sides of the coin here, right? What is the actual need from the fintech standpoint and what the traditional banks are driving towards. So the challenges that neobanks are facing is more on riding on the same guardrails of the partnership, and the challenge from the traditional bank standpoint is though they are very receptive. Some of the banks are very receptive to partnering with new age neobanks, but they do not have the bandwidth to work with a lot of these niche neobanks coming up, right? Let's say there is a traditional bank that is definitely willing to partner with more neobanks, but they did not have the resources to cater to, let's say, there are 10 neobanks operating in different niche segments, right? The bank does not have the resources to go ahead and enable that partnership. So the neobanks feel that they are not served right, though there is a partnership there. They feel that there is some challenge integrating with them, and their go to market is getting impacted, right? That is definitely one challenge that we are seeing on the neobank side. The again, the other side of the coin is when we talk to traditional banks, they also want to go down this path of having a digital only bank, right? A lot of the traditional banks today want to operate on a digital only fashion, or at least create a flavor that is digital only, right? While they enable most of, they will still have uh, the physical presence. They are also trying to have a digital only version catering to different groups of customers, right? So as a company sitting in between these two, we are trying to understand what is the real market play in this, because the needs are totally different, right? A bank cannot go and cater to 10 different specific segments, and the neo bank cannot provide all uh, the facilities that a physical bank or a traditional bank is providing. So the challenges are there in multiple places. So so what I want to conclude by saying is that though I agree that the neobank is not fairly is not very well regulated within India, but with the new new segments coming in and all the requirements for neobanks to operate in specific niche segments, I think once we have a fair amount of regulation operating in this space, this is definitely going to grow like how it has happened in the UK and the European markets.
Thanks, Mr. Kannan. I again agree and appreciate the viewpoint that you're bringing in. And I think the previous speaker also brought in exactly the same point, Mr. Praveen Khanna, that there are these societies advancing and the requirements are changing. There was a time when most of us, including me, was very comfortable only using a checkbook. But this generation, if you tell them they don't have the patience to sit and write a checkbook, by a click of a button, they can transfer and do the transaction. So, as it is the fast food, so is the fast banking. And as the economy is getting integrated so beautifully, and new sectors are coming up, and then banking happening at different distances, that going to the brick and mortar branch is a real challenge or not required at all. So I agree, different segments are demanding banking and all in different way. And because of the fintech, we are able to tailor make our products which can take into account these differentiations. So that is the beauty that the technology is bringing in. I can tailor make a product. Now, as far as technology is as far as regulation is concerned, because these technological advancements need a platform to operate from. Be it YONO got along with the State Bank of India, and the platform is State Bank of India. Be it other products, you will always need a platform to start the fintech, and the platform is being regulated by the Reserve Bank through its very strong, robust regulatory mechanism as well as supervisory mechanism. So I'm not too worried. Of course, it will come in. I'm sure it will be more rigorous, but I'm not too worried that this technological advancement individually has to be regulated by the Reserve Bank. To illustrate, when handheld devices were made, the manufacturing of handheld devices is not what the Reserve Bank as a regulator was worried or any central banker was worried. It was the application of the handheld devices in conducting the transactions. That was the point. And the commercial banks who availed the services of the handheld devices, and I know there were 5 or 6 of them operating in the country, producing the handheld devices, the bankers would make sure that they fulfill the conditions of maintaining privacy, uh, the connectivity with the customer, and those things. Well, we are all thinking together, and that's the very purpose of having a seminar, that we put our minds together, think, and ASSOCHAM at the end of the day is going to put all these thoughts together and share with the regulator. So with this, let me now invite the last speaker in the panel before we go to our special guest, Shri Gautam Sinha. He is the VP Technology, Loan Tap Financial Technologies. Mr. Gautam Sinha.
Thank you, sir. Hello, everyone. So I've been hearing the conversation. It has been great understanding of Neobank. To me, I'm a technology person, and it looks like the extreme automation, the artificial intelligence, the data, everything is actually giving an outcome, right? Byproduct, which is making a clone of exact bank. Gradually, we are actually leading towards a clone of an exact bank with the use of an complete extreme automation, personalization, data, and that is going to be named as Neobank. That's where we are actually leading to, right? So we have already seen the 3 ecosystem, right? The payment ecosystem where the data flow has been very, very high, right? And everybody has been using GPay, PhonePe, and the amount of transaction data which is coming up is extremely very high. And it is very good to actually make up a payment behavior, personal behavior, the persona of a customer, right? What customer exactly want and what is the way they are actually paying. So we have seen a very high level of transaction which is coming up in this area. The other part is basically the banking system, where we see somewhat stable customers which are there and transactions are somewhat on a medium range. And then we have a lending space where we have seen that we have a engagement of the customer is for a longer duration, but there are less customers from getting engaged. All these 3 segments are exchanging data to each other and they're fulfilling their needs, right? And ultimately the benefit is going to retail customer and SME. Retail customer, I would say, in a way has been able to use digitization to a great extent, and they're actually able to fulfill their requirement to a great extent, right? Whatever they need so far, but still there is a way to go. MSME, I feel they have a lot to do, right? And when I talked about extreme automation, right, there's a lot to get in their area. MSME section, they cannot afford a complete dashboard, UI, right? Spending a lot of money with the external vendor, creating an AI structure altogether to take a decision, right? So particularly they need extreme automation and everything, including accounting, reconciliation, right? Everything required to be automated at their extent. Why these things are actually getting successful is because of the architecture, and all these 3 ecosystems are closely working with each other and exchanging data. And then we have API in place, right, which is making the life much easier. The end product again is going to be quite similar to that bank, right, which makes you feel entire banking operations is happening same as you go to a physical bank. So a lot of things required to be done, right? Lot of data required to be manipulated. So we have to interpret basically to see what are the offerings for the customers, right? Which particular product required to be offered to the customer, right? So data probably gives a better insight of what customer needs. So sort of personalization as well. At the same time, a lot of, I would say, security aspects might also come into picture. We have recently seen that a trust factor is very important in case of the neobank, I would say. Trust factor in the sense the digital trust, right, has to be very, very strong, because at this particular point of time, even we are struggling with the traditional banking system, the security of the traditional banking system, right? With this neobank coming into picture, we'll have n number of security issues also which we need to address, like data localization, right? Where exactly customer data is going, customer has to be very much aware of where exactly the data is getting stored. At the same time, basically hacking and other part as well. So all these things, I believe there's some way we have still to travel, still to go, right? Finally, we conceptualize the entire neobanking space. Thank you.
I must thank you, Gautam. Those are very important issues which you have brought on the table, the customer privacy. And when it is a fintech company, for them, the customer is the bank, also the platform which is being used. So it's just not the customer who's conducting the transaction as Mr. X or Mr. Y. It is also the bank which is going to ask these questions as to how and which cloud are you putting my information and what are the firewalls that you have. So I totally agree with you that this is an area which will have to be absolutely respected, investigated, and probably the regulated. So the commercial bank with whoever the technology provider is playing a role will have to be very cautious. So I must thank the panelists for their excellent observations and comments. And now for the next 5 minutes, because all the panelists have already given their mind and shared their thoughts, if any one of you would like to give another observation, having listened to each other before I go to the special guest. So, yes, please, Mr. Nath, can you go ahead?
Yeah, I just wanted to clarify that please don't take it when I said that the term bank should not be used. I'm for digitization, and the force of digital reckon which is happening in the country is unfathomable right now. But Mr. Singh, when you say you are not worried about the term bank being used, let me give you an example. Think of a so-called neobank having access to 1 million customers and then opening current and saving account for a back-end bank and have access to the transaction data flow, and now add a product which is a, say, consumer lending or P2P lending, wherein the same customer which has opened and current and saving account is now being promised 25% interest return by lending to an next segment. The trust factor attached to the word bank, the same customer would get lured to deploy his money, which would not be going in a banking system, but to some other market. And when that money would not come back, there'll be a massive hahakari which would happen. We will end up then regulating these entities big time and making corrective action. So my only request was it has to be done now. That was the only point I was making. Thank you.
I appreciate that. In about 15 years back, you would be aware, non-banking finance companies were not being regulated.
Yes.
And the very fact that they use the word non-bank, the word bank came in. So, and when you call them a non-bank finance company, they were generally written. And if you are from Delhi, you would see it in Chandni Chowk and everywhere, X Bank. Now, when you go and ask them, are you a bank? No, I'm a non-banking finance company. And you know that the hahakar which happened, and therefore they had to be brought into the net of regulation. So I appreciate that fact that one has to be careful in the usage of the term bank. I'm not denying that. But thank you for cautioning all of us. Anyone else amongst the panelists who want to make an observation? Yes, Mr. Doshi.
Sorry, this is Sridhar.
Sridhar.
Yes. I think one of the maybe clarifiers I'd put in is what we are seeing in globally is that neobanks are getting regulated, and they are falling under the purview of the local regulator. And we're not proposing that they shouldn't be. What I'm saying is that in a bank, we'll call it a challenger bank, neobank, whatever the terminology we use, ultimately markets are moving towards regulating them and providing them license to operate in this new model, essentially where there is not the physical building. Yes, in some cases they may be attached to a bank, but in other cases they are a standalone and they are very segmented, very niche type of market. The delivery mechanism is fundamentally changed, and how they bring the customer to the table into the bank is fundamentally changing. Yes, a neobank can be classified by the various business models that have come in the past, but this model of a digital-only model is starting to take presence in many markets, and it is something that we believe that India will also have to contend with. It's something that people are looking forward to, but at the same time, it doesn't mean that the partnerships right now that exist among banks is a convenience, it's a requirement, it's also to facilitate a variety of things. But how many flavors of a challenger bank, a neobank will India have, and which ones will we regulate, which ones will we not regulate under that umbrella? And will the regulations be fundamentally the same as we have for a traditional bank, or will they be modified to fit the business model or the channel per se? Is an open question yet.
Sure. Thanks for that clarification. Anyone else amongst the panelists, please?
Sir, a quick thing. Again, I would like to reiterate that we have all the regulations I see in place for a neobank. There are a few legs of a banking transaction. For transaction and payments, we have wallet licenses, we have payment aggregator licenses. For lending, we have co-lending model already approved by RBI. We have FLDG model running. We have NBFCs. And for account aggregation, the Samati is already in place. So all the way, I mean, these are all broad piece of aggregation which a neobank is going to do, and we have all the regulations mostly in place. Data localization on the security front is in place. Aadhaar is in place. So I think India is already there inside deep with all the regulations in place. It is just regulations are separate for each set of activities which a bank does, and which can be rolled on a wrapper and run as a fintech or a neobank. Neobank is just a word to me.
Sure, I agree with you, and I think the regulation, how much has to be on NBFCs, how much on cooperative banks, how much on MFIs, these are issues which the regulator has to take a call. And I'm sure as things become significant and as they become important in the course of time, the regulator would obviously be playing a role. With this, I think if there are no other panelists who has a view on each other, then I would like to go ahead. I would like to go ahead now and invite Mr. Ajit Pai, who's the distinguished expert of economics and finance at the NITI Aayog, who is heading the vertical on financial sector there, significantly making contributions into policy making, given his vast experience that he has, the global experience that he has, and is a dear friend of mine. I would now like to invite Ajit Pai to please share his thoughts.
Good afternoon, everyone, and thank you, Charanji, for that introduction and also the opportunity to speak. It was actually fascinating to hear all the other panelists talk about their various businesses and their perspective on neobanks. To begin with, I think I'd like to step back and actually talk a little bit about the macro situation in the country. You might wonder why I'm stepping back specifically from technology and looking at what's going on in the country. But very broadly, when you have a look at the structure of India right now, its economic and financial architecture relative to the rest of the world, there's one thing that we can point to that tells us that the risk in India is significantly lower than other parts of the world. And that is the total level of debt that is there in India relative to the rest of the world. It's a mixed blessing. And the reason why I say it's a mixed blessing is that the total debt to GDP for the global average right now is approaching 400%. It's north of 370%. India at 150% is a fraction of the global average. You're not even talking about the largest economies. But what also goes hand in hand with the fact that we have the lowest debt from an overall perspective is that we have very high public debt, about 90% of GDP, which is very high on a global basis. But our private credit is very, very low, approaching about 60%. And it is the growth of private credit that has helped the vast majority of recent countries that have climbed up in terms of per capita GDP very quickly. That has helped those economies, whether you're looking at South Korea in the 80s and 90s, you're looking at China post the world financial crisis, you're looking at Vietnam in the past 15 or 20 years, and you look at the private credit, that's been the single biggest driver of growth and increasing per capita GDP. So now I'm just moving to the Indian context relative to a global context where the globe trade is slowing since the world financial crisis, economic growth is slowing, too much debt in the developed world, and India itself is growing. And why are we so optimistic about India? A large part of that is to do with the fundamentals of the Indian economy, the digital financial inclusion that all of us have created. And it was so encouraging to hear about the business models that are coming on the back of that. And what was responsible for that? What enabled the Jan Dhan, the JAM Trinity? It was mobile penetration, which started happening and taking off just less than 8 years ago. There were less than half the mobile phones and less than 1/10 the number of smartphones in the marketplace. So tremendous penetration on the digital side. The seeding of Aadhaar about almost a decade ago is when it began, but the momentum over there that has created unique identification, long overdue. And then when we finally look at it, even the Jan Dhan accounts, I think there was a question that I saw in the chat that asked about, when 75 to 80% of the people don't have bank accounts, why are we talking about neobanks? But 420 million Jan Dhan accounts opened. The single qualification for a Jan Dhan account is that you don't have any other bank account. So we know that in the past 6 years, there are 420 million people that didn't have bank accounts that have bank accounts now. We don't know about the usability of them, but we do know that these now exist. So this massive foundation building has happened, but we have borne the costs. We have borne the costs of formalization of the economy. Do you really think an economy where less than 2% or less than 3%, it was 2.5% filed taxes, and a fraction of those actually paid taxes till 6 years ago in this country? That was the state of the formal economy. Today, you have, or at least until 2019, it had already gone up. The latest numbers we don't have. But you watched a doubling in the penetration of tax filers. It's almost 5% of individuals now that file taxes. Number of businesses that file taxes is increased. Now you have, in terms of digital penetration, we got all of GST and formalization in the economy, where a system put in July of 2017 has suddenly started providing a whole stream of data on cash flows, etc., that was not separately available. That has combined so many different factors and taxes, and whether it's excise in some cases, whether it's service tax in some cases, sales tax, so combined so many taxes to provide an integrated data stream. Now, all of this foundation building was going very well. And if you speak to some of the credit scoring agencies, if you speak to the TransUnions, you speak to the Equifaxes, you speak to the Experience of the world, very different from the old school. The old school is the credit rating agencies, the S&Ps, the Fitches, the Moody's that are backward looking. By the time they downgrade, the cat is already out of the bag. But these forward-looking lenders that are for non-collateralized lending had a stream of data providing to them that we thought would start India off in embarking on a huge acceleration in private credit, which couldn't happen in an informal economy because there are too few businesses and there are too few individuals that were part of the formal economy. A prerequisite of the banking system, by and large, as you're well aware, is to actually see the financials of companies, financials of individuals. We worked all kinds of things around it, but once you had RERA, once you had the level of formalization of the economy increase, there's a lull that happens. There's a slowdown in credit that happens, because as the credit scoring agencies will say, you need at least 3 years of data before you can start making reliable predictions on cash flow based lending or on other forms of lending on reliability in terms of credit scoring. 7 to 8 years is ideal, but you're looking at 3 years. So it's in this context that we looked at what happened within the Indian banking system and a huge slowdown in credit growth that started happening, all the way from 2011, 2012. We watched a deceleration in credit from the scheduled commercial banks that began at around north of 30% year-over-year growth in the 2011-12 timeframe. It decelerated all the way down to mid-single digits today. In the middle, you watch this race by NBFCs to fill that gap. So in the 2015-16, while the balance sheets of the banks were all getting consolidated, we watched the NBFCs between 14 and 19 off to the races. At the end of 2018, we had the ILFS issue. The NBFCs were doing that on the back of course, the asset liability mismatch, a lot of commercial paper, short-term financing that was talked about. I think the NBFCs were sort of the key users or arbitragers of that. That ended, that gravy train for the NBFCs and fast growth ended, even though there was a lack of credit in the market after the ILFS because there was no lending there. So after that, we had the banks have to step back in. The biggest lending to NBFCs was from the banking sector. You watch a 50 to 60% growth in credit from the banking sector, the scheduled commercial banks to the NBFCs in 2019 and 20. So what we are seeing now is a different phenomenon. What we are seeing now is what I would call the impact of COVID. So we had this huge foundation built, a digital foundation. We watched the NBFC's key source of funding dry out. Otherwise, the NBFCs would have been off to the races after the market appetite for commercial paper disappeared. That arbitrage is gone. Their source of capital is now the commercial banks. So you already got a very high threshold in terms of cost of capital. Most NBFCs haven't geared up to the bond markets as yet, and the non-AAA, AA bond market is still not there. Single A, triple B is where, which the government, we're trying to figure out ways and means of accelerating that. But very clearly, the NBFCs had a challenged business model. It is in this environment that this entire concept of neobanking, we can call it by any name. I won't focus so much on that name right now. There are the soft banks of the world that are not direct lenders that do all kinds of things, but I won't go with the name right now. What we look at right now is they're meeting an unmet need of the Indian public. There is an unmet need where there's credit starvation in the Indian market. It is what used to be a highly informal economy that is very rapidly formalized. There's a time lag between which that data is going to start becoming available and reliable. There's been a huge reset because of the pandemic, which has created another big question and interruption, not just for the traditional banks, but also for the scoring agencies. Because right at the 3-year mark, when you could start increasing the lending, you had this interruption of business, which makes it difficult to determine the difference between someone who's a reliable and unreliable borrower. If everyone is frozen for about a year or for 6 months, you have moratoriums, you have lots of these things that disrupt our ability to be able to discern who's a good risk and a bad risk, to be able to discern who's a good business model and a bad business model. So all of these things have been interrupted by the pandemic to make things far more complicated for the traditional banking system. And therein lies the opportunity, I think, for what we call neobanks. I think overall right now we have AI, we have big data, we have fintech companies. We now have real-time payment information, which is very different. It's creating a stream of data right now in real time showing the improvement. So the time to market, rather than going for financials, ITRs, all of that with a huge lag, going in for the moratorium period, now we have seas of data that are getting created even during the pandemic as the economy rebounds. We have the ability to see even much shorter periods of time of 6 months, 9 months, 12 months, 3 months, what the trends are, and be able to adjust so that our economy can now bounce back. All the investments that the government has made, that industry has made, the infrastructure, the mobility that we have brought, that the telecom companies are providing at ridiculously low prices, the lowest in the world, the data that we're providing at the lowest in the world, the enablement of Aadhaar, all of that foundation building that we have not seen show up in our overall numbers. You're seeing some of that GST, you're seeing some of that growth, but all of that right now is the opportunity. And we know that for balance sheet reasons, the NBFCs, because of cost of capital, while they are readjusting, that the overall banking system has to be reharnessed. And why do I say that the overall banking system has to be reharnessed? The banking system's deposits have been growing in double digits since this pandemic began. The credit delivery from the traditional banking systems, including through neobanks, is growing in mid-single digits right now. Even the Jan Dhan, people say that the poor have no money, please give money. Even Jan Dhan accounts today are seeing their balances grow at 11.5. This is the bottom of the pyramid. In India today, what you call the bottom 1/3 of the population, and we are seeing their deposits growing still at a double-digit pace. Very clearly, the banking system, whether it's public sector, private sector, foreign banks, all of that, they're not able to disintermediate fast enough. Even the growth in the small finance banks, which have been very effective the past 4 years in filling that gap of the banks and the NBFCs, has come down right now into the 20% plus range, but well below what they were growing in the past couple of years. So it is at this stage that we've got to ask, why is neobanking the buzzword? Why are these functions of banking correspondent, of AI, of big data, why are they coming right now? And it's because those foundations are laid and the timing is right. And if India does not figure out a way that the deposits that are going into the banks go out much faster, out into the public, then the disintermediation function of 60% of GDP, numerically right now, the scheduled bank system has close to 60% of the advances, has 60% of GDP numerically, out as advances. That is what is going to be slowing the economy, because that's a massive disintermediation function that is not being fulfilled. If deposits are growing so much faster, the credit ratios are coming down for the banks, and the banks do not know how to lend, because all those metrics, those 3R financials that we're talking about, all the historical data is fractured because of the pandemic. So the timing is fortuitous. Of course, the electronic system also helped us during, with DBT, with all of that, to sort of provide benefits from the government to make the pain a little less at the bottom. But the most important thing is to get this economy going again. We are now only at 18% of the world average per capita GDP. China is right now close to 100%, almost at the world average of per capita GDP. Just in the 1990s, early 1990s, India and China were very similar. And since 2007, 2008, it's not been global trade that's been driving China's per capita GDP. If you look at their private credit growth, it's been primarily that has decided that, both in terms of investment within the country and also in terms of consumption. China's focus has been on domestic credit to drive their growth, the biggest focus over the past, I would say, the past 12 to 13 years. Now we have built the foundations for that. We have got the electronic base, the identification base, they've got a stream of data. And now this reset has been most unfortunate. It has, of course, accelerated usage of mobility, of technology. A lot of people that would feel technology challenged are now beginning to use technology over the past year and a half. There wasn't an option. So it's driven this transformation in India, the usability, financial literacy, things that we talked for decades about. It's helped formalize the system. The revenue, if the government of India is very buoyant right now, but what we really want to focus on is the delivery of that private credit within the system to drive private investment, drive private growth, and all those people that were part of the informal sector for various reasons, whether it's compliance, too much regulation, all of that. We are trying to bring down the barriers to encourage them to enter the system and grow much faster. So there is encouraging signs. GST registrations at 42 million is more than all of those other registrations combined when you combine it. So that system seems to be working. There's an incentive to join and formalize. Credit is one other driver that can help people formalize if they think they'll get money from the system. And so we are thinking of various other means that we can use, but we require help. We require companies such as yours that are working and innovating. The models will evolve. Right now, you're small. Once upon a time, as Dr. Charan Singh rightly pointed out, we started with the bench, we got the walls. That was a neobank back then. We had the scheduled commercial banks. We had the foreign banks. Then the private banks were the big growers for a long time. Then the small finance banks were the big growers for the past, 4 or 5 years, 70%, 40% growth as a combined entity. And now it's the time for the neobanks, because in this structure, with the pandemic, with the kind of financials we are looking at, the kind of damage and scarring that's happened. It is only the people, the ones that will be able to spot the trends fastest and get the money into the system fastest and spot all of that, is not the long backward looking regular scheduled commercial banks. Their rules, their objects are very difficult. We know they have the money on the balance sheet. The deposits are there. They're growing in double digits. The credit deposit ratio is down, right down to 70%, probably even declining further as these goes. So we are looking for models such as yours. The time is ripe, and we think that that growth is going to happen very quickly. The regulatory aspects will follow, as we see in most cases. As Dr. Charan Singh has pointed out, NBFCs not too long ago were completely unregulated. As they become bigger, as they become systemically important, as the risk to the system increases, that will come. Don't worry about that. Right now, it's so granular. There's so many of you. The relative risk to the system is fairly low. To start putting in too many controls too early would probably not be very helpful. So what we have to see is monitor very closely, see the size of the risk, what is the risk as you grow, and then eventually start bringing you into the overall financial system in a more organized way. But at this stage, I think the stage is clear, the foundations are laid. I think there's a big runway for growth, hopefully even faster growth in the small finance banks, 340% growth for the small finance bank in 2017-18. So we want to be seeing growth rates that are similar, and we need that credit in the market as quickly as possible in the fastest way with financials that are not similar of most of the people you'll be lending to of much earlier. With that, back to you, Dr. Charan Singh. Thank you so much for the opportunity to speak.
This was really beautiful, beautiful. I really wanted you to come and speak at this forum because I knew you have the experience and the cutting edge knowledge on these issues, and you've brought them out so beautifully well. I totally agree with your conclusion. The systemically important NBFCs were brought in at the right time. The regulator also has a limited energy and need not monitor everything and lying so scattered across. So that's a very genuine observation which you have made, and I totally agree with you. With this, I would now like to go over to Mr. Subhash Chandra Garg. He is the chief guest for today. He is the former finance secretary of our country, and I've known him from 2002 when he was in Rajasthan as the finance secretary. So it's a privilege to know him, his knowledge base, the crystal clear thoughts that he has that I've seen over the last 2 decades while interacting with him. With that, I would now like to invite Mr. Subhash Chandra Garg to share his thoughts. Mr. Garg, please.
Am I audible now?
Yes, you are.
Yeah, right. So, and also thanks to ASSOCHAM to bring a subject which is extremely important in the current context for a discussion, I think. So let me begin by sort of bringing up what the central issue is today and what this new bank has brought that issue up for our discussion. See, new bank, in my judgment, whether we like the terminology, etc., that we'll discuss a little later, has underlined the big necessity for digitalization of the banking, or to create digital banks for the future. So what new banks do, as far as I understand, is that they are, some people said this, they wrap around, so they are tying up nicely with a bank, which is a licensed bank, regulated bank, and sort of by providing different kind of business services, which includes accounting, tax, and many other things, which allows them to collect data and then bring the financial services to those customers, whether it is MSMEs and others. And those financial services are basically opening a bank account in the bank with which they have tied up, and also arrange credit for them. So and all this is done in a completely digital manner, right? There is no physical branch, there is no paperwork in that sense, and therefore the neobanks have brought digital banking on the credit side, and that's where I think they are adding value, and that is what we need to discuss. Prior to this, the fintechs brought the similar kind of disruption or sort of service digitalization, whichever way you want to call it, to the payment space. The banks were primarily I'm not talking about the payments through the cash system that we can discuss separately if required, but the payments made by using the deposits in the bank, right? That payment space was quite slow in the pre-fintech period. You also mentioned about it, Professor Charan, that earlier system was based on issuing checks, getting bank drafts, or other kind of sort of promissory notes, etc. And that used to take months. If you sort of depositing an outstation check, it would take weeks to realize. If it is a local tax check, it might take few days to realize, etc., etc. And the system of payments was functioning in a very slow in that non-digital environment. The banks were essentially physical entities. We may call them traditional, and all their functions, whether these was deposits, which they would keep track in the registers which they kept, which were not digitized and therefore not available to anybody else other than that branch. And the payment function, the deposit function, and the credit function. Credit function, in fact, is the most difficult in my judgment, which requires a lot of assessment of credit worthiness, assessment of the risk of non-payment and things like that. All those functions were being done in a physical sense, paper registers, records, not in a digital way. The payment space got disrupted first when the fintech brought, and today we have fantastic systems, UPI, IMPS, RTGS, etc., which allows and which is making practically 98% of payments by value instantaneous. When you can make payment instantaneously, why would you do check or why would you go to the bank for a bank draft, etc.? So payment space has got completely digitalized, right? The account space has also got, bank account space has also got quite digitalized. So whether these Jan Dhan accounts, these are also digital accounts, or the non-Jan Dhan accounts, which are also digital accounts. And today, when UPI makes payment, or you use the UPI to make payment, practically NCPI has created all the bank accounts. It has brought them into one single virtual pool. That we have a single virtual pool of 60 or 70 crore accounts of India, and it becomes as easy as that from one digital click you are transferring from one account which is digital to another digital account, and payments happen. So both these spaces have got digitalized, and the so-called traditional banks or physical banks have seen that space digitalized for them. So it's not that today's physical banks are entirely physical. They are quite a lot digitalized and digital. But what is not digital so far is the credit part. The credit part, whether it's to retail credit for housing loans or consumption loan, vehicle loans or whatever, and the business loans to SMEs, to others, most of it still based on a lot of assessment, which is done based on property papers, business papers, sort of so all whether these papers are registration, others, bank accounts detail, credit registers, other kind of things. These are all still a lot physical. And here, let me bring a little bit of a distinction between the banks and the non-banks also. So in my judgment, the banks and non-banks both, as far as credit is concerned, are doing the same function. But banks can open accounts, they can keep deposits, and they can also create deposits. Whereas non-banks cannot keep customers' accounts, and they can't create deposits, and they can't create credits. So there is a difference between bank and non-banks on the resources side. But on the credit side, the banks and non-banks do the same kind of thing. It may be a different regulatory option that you don't allow the banks to do certain kind of lending. You can't do the real estate lending. You can't allow investment in shares or things like that, or consumption loans. And earlier, 20 years back, even housing loans were not allowed to be given by the banks. It was considered non-productive sector. Whereas the non-banks were doing all these kind of lendings. So that is the difference between non-banks and banks. There is no other difference, right? What neobanks have brought to the table, and what they are doing is that based on the sort of digitalization of the core business function of whatever SMEs and others they deal the business in, they are facilitating much better credit assessment, much faster credit assessment, and qualitatively perhaps far more. And as I think Ajit said, this enables a better assessment of future creditworthiness and the future ability to not default, assessment of that. And that is why these credit scoring and other models allow you for the banks to lend not based on the collaterals or the other guarantees, etc., but based on the assessment of the business potential and the creditworthiness and the ability to pay, which to my mind is what the new banks are attempting to do and to bring it. And therefore, I welcome and consider this as a tremendously positive development for the smart digital guys to set up these businesses and facilitate and encourage, and what Ajit was again worried about, very poor lending growth in the country to make it better, and also to expand the reach to the weaker. Today, 10% of MSMEs only have the credit from both the banks and the non-banks. But what this segment or this new innovation is able to do is to reach out to many more, and we can expect it to expand to much higher levels of credit and to much more people to get that credit. So that is, I think, gives me reason to say that we must welcome this model to do it. Incidentally, the other space on the crypto side is also expanding credit, but in a very different way, because they have a very different model of sort of doing database management. So they are on decentralized, decentralized, but that entire decentralized finance initiative, which is coming helped by smart contracts and others, is also digital banking of a very futuristic kind. So I, in fact, welcome both the kind of new banks which I think are on the so-called traditional or the centralized database system of banking, and the decentralized finance, which are on the decentralized or the blockchain kind of banking of the financial space. Now, having said that, and coming up to this, what is the next question in our, what is the next policy question in our case? I think there are two policy questions. One, are we going to allow the credit side of the banking also to become digital? And then the banking will become digital banking. In our country, so far, to my mind, there is reluctance to allow full-fledged credit digital banking. Still, we have so many regulations. Anybody who takes a housing loan today still has to fill in hundreds of forms. If you have to take loan for SME from a bank, whether you do it in 59 seconds or otherwise, you still have to provide enormous amount of documentation. We are perhaps a little reluctant to move onto that side. So what do are we prepared to move towards that? It has been mentioned in this forum today that there are many countries in the world which are licensing full-scale digital banks, and they can do all the banking function, from opening account to making payments or deposits accounts to lending, entirely digitally, 100% digital, nothing paper work. But we have not licensed, and perhaps we don't have even any approach paper so far of the kind of digital banking which we envisage in our system. There are two problems why perhaps the Reserve Bank and the government has not thought of this. One, we have extremely fragmented banking on the credit side still. We have full service banks, we have small banks, we have cooperatives banks, we have urban cooperative bank. Even on non-bank side, we have varieties of kind of non-banks. Somebody is doing infrastructure, somebody is doing microfinance, it requires enormous amount of regulation on the credit side, as well as on the banking soundness side. That's one reason. Then we have a lot of regulations relating to priority sector lending, other kind of lending. I think we need to think through that in digital space, these kind of constraints will make digital banking somewhat more or less exciting. So that's one thing. Second thing to my mind is, and this is not generally noted, we don't have any sort of law to sort of define, lay basic principles, law relating to credit management in the country. We have on the payment side. So we have Payment and Settlement Act, which regulates payments. And that is why it has been easier for the Reserve Bank to sort of license the fintech companies as payment system providers and the payment infrastructure kind of thing. And that has enabled. But suppose tomorrow the Reserve Bank were to say that let us license the neobanks without giving them banking license, only as the fintech interface between the banks and the customer, like we have done it for payments. Under which law, under which system will the Reserve Bank license them or regulate them? There is nothing. So I think we should think about that. We have many other developments Today, debt marketplace is coming into shape all over the world. We also have a smaller version of that as peer-to-peer banks. As I said, we also have a lot of credit kind of creation coming up on DFI, this decentralized financing system that is unregulated. I think we should come up with a kind of legislation to define and regulate credit and declare probably the Reserve Bank uh, as the regulator for that. And then I think the Reserve Bank would be able to bring the system of regulating the neobanks as the fintech counterparts on the payment side to work with the banks. At some stage, I think we should come up with a full service digital bank. At that stage, today's new banks might actually convert themselves into digital banks, and some of our non-banks might also convert into completely digital full service banks. And that in an economy in the world which is fast digitalizing, where data is everything in terms of making products, providing services, and making payments, etc. I think we need to do it. So my recommendation to ASSOCHAM would be to work with our all these people who actually have are pioneers in the credit space, rather than sort of discouraging them to come up with this kind of thing. And sooner we do, the better. Otherwise, what I think Sachindra said at one stage, that there is a possibility that if you develop credit in this manner, in a completely unregulated, undefined kind of manner, there might be scams on the credits. There might be, and then there would be nothing. Where do you regulate? Where do you sort of put blames on that? So even for that purpose, I think it makes sense. I'll stop here with the final conclusion of mine, that the new banks, we have 10, 20, 15, whatever numbers we have come, they are the pioneers. They must be encouraged. Their models must be studied. We should learn from them. And then we should take two big steps of bringing a law to regulate credit, and also think of getting the digital banks in the country sooner than later. I think we'll be serving the cause of India's and the credit growth in the country much better than that. Thank you very much.
I must thank you, Mr. Garg, for your thoughts, for your thinking on these lines that you just mentioned. I know you come from the government, but I am of the view, and I was surprised when the fintech companies were saying, look, we are missing out the regulation. Because I was wondering, why are you missing it? The whole computer industry in Hyderabad and Chennai was wishing that we don't regulate them, right? So there is a give and take, and there is a cost and benefit. The regulation is
at this stage. See, in the real sector,
right.
there is no regulation. So
Right.
the IT companies are on real sector, producing products and services. The financial sector is all regulated.
Right.
And here, these are the fintechs and the neobanks are on the financial side.
Right. I agree
In the
with you.
financial side, you can't work without regulation.
Right. I totally agree with you. The NBFCs, though, continue to work for about 100 years and flourished. So I totally agree with what you are saying. And as we have seen today, the voice has come from the entities, because I'm sure they are worried too. And they feel that, and look, I'll just give you an illustration of today morning. I had to make a payment of 12,500 and I chose MPS. And by mistake, 12,500, I put a zero behind and it became 1,25,000. And before I could realize, my balance just crashed. And I said, wow, there is power to technology, but there is also, you have to be fully awake and alert while you're using these tools. So I totally agree with you that in their enthusiasm, they could go overboard, and somebody regulating them is something which is necessary. So I agree with that. But as I mentioned, when there is so much to do, so much to develop and experiment with, I was at the beginning of the talk thinking that most of them will tell, please leave us alone, as the Americans left them alone. But I was so surprised and pleasantly though that they said, please step in right now so that something doesn't happen at the end. So I think the private sector is also evolving. In America, when all these things were happening, I used to be there. And that is where touch me not was the philosophy of the private sector, or light touch was the regulatory mantra. But then, after the Lehman Brothers, everybody realized the touch me not and light touch mantra were not in the right spirit. In any case, we have had a 360-degree discussion today. And I think it's been a very pleasant and very rich discussion. And ASSOCHAM will have enough meat for the recommendations. We have gone beyond the PwC report, as you would have seen or glanced through the report. We have gone beyond it, and that's the very purpose of bringing in the young, bright minds with the experienced ones, so that we can find a middle path. It is in this context I want to thank each of the panelists for bringing their bright thoughts, PwC for the report, Ajit Pai bringing us the global experience, and our chief guest for the day, Subhash Garg, putting in a word of caution for all of us. With this, now I open the session to question answers. We have 19 minutes. Happy to take any questions. Before I open to the larger audience, I would first offer to the panelists if they have any thoughts, observations, comments, or questions for two of our guests. And once we have done with the panel, we will move on to the general participants. So amongst the panelists, please.
I think, sir, this is Praveen here. To the
Okay.
point on access to more credit, I think the new account aggregator network that is being built in India, that is going to help a lot. So for fintech players like us who need to access the MCA reports or bank statements or GSTN reports, based on just the consent of the borrower, we are now able to access those reports, analyze it, and determine the credit worthiness of the borrower. So that account aggregator network and the APIs that we can develop on top of that as fintech players, that's bringing more efficiency in the credit model.
So the account aggregator will do whenever they are operational what NCPI has done for the payment balances, right? So that's a very valuable, very good development. I think we'll need to still see whether that credit information would be as richly available from the GST data to business transaction data to other data, and that would be also shared. It's all not only consent based, but the institution has to provide, user has to access what kind of model they will, pricing, etc. It's not as easy as the banks in CPI kind of model. Let's evolve, but whatever it is, it would definitely help in better credit assessment. But that's one part of the credit assessment. You still have to exercise judgment, and that judgment is made only by the lender, right? You can't mechanically input that data from let's say account aggregator and say, while this goes, the credit goes. It would not be. That is the difference between payment and the credit. So I think still a lot will have to be done by whoever lends, whether it is the banks or the neobanks assisting the banks. So that is useful, but not completely.
Totally agree, sir. Totally agree, sir. And in our experience, we've actually been sitting with the credit officers at the banks, understanding the credit policy to actually design those digital products and those journeys. So it's a core development model that is being practiced. That collaboration between the fintechs and the banks.
That would be quite interesting and challenging.
Anyone else amongst the panelists, please?
On the account aggregator side, I think it's currently at a very nascent stage, right? With a lot of banks coming into picture. And once that gets, the collaboration even happens, right? The insight would be very, very important to bring up the useful information out of those various accounts, which it's going to pull. And in a very simplistic way, currently, like the credit manager has to evaluate, right? And they have to do a lot of calculation out of it, right? And the same thing is going to come. Any fintech is going to interpret it in a much meaningful way and easily understandable is going to create a value out of it. So I think that will surely come, and we'll have a lot of in-process things which will actually be cut short, right? And the entire credit will actually happen in a much, much faster way than is currently happening.
I don't want to dampen the enthusiasm about the account aggregator. And Nandan Nilikani has been going to towns, sort of making that this is the biggest next disruption. But as a fact check, the account aggregator as NBFCs were created in 2016 by Reserve Bank. We are 5 years down the line. The two guys were licensed in 2017, but they did not get any data. Still, so there are a large number of issues about your data with the insurance companies, data with the SEBI regulated entities and others, and still, even with the banks, a lot of data is still not digital. So much of the fixed deposit, and I think it's about 70-75% of the fixed deposits still are physical or electronic, but not digital. So it's going to be a huge way towards that. It's useful. We must do everything, but I don't think we should be over complacent.
I think, sir, what's being said about India is that India will be a more phygital journey. So the physical and the digital will coexist in India,
Exactly.
especially in the rural areas. And hopefully, one of the papers that I was studying says that the trend will be more towards digital. And by 2026, 60% digital versus a 40% physical journey is what's being predicted.
We should do that on credit side. If you can achieve that by 2026, 60% digital credit, that would be fantastic. That would be great.
So I asked a question around the data side. You touched upon it, Shwashberg. The interoperability or the data rules that's set. Obviously, data localization is very important, but for credit, this is the fundamental challenge, right? We don't necessarily have even within the same group companies, they're very limited in what can be shared. Even under the umbrella of volunteer data, meaning what I give permission to. Your commentary on that and the need for that when it comes to moving credit much more aggressively into the hands of our consumers.
You address it to me?
Yes.
I think that's the most important question. And our track record, RBI has created CRILIC as a database for all the credits of 5 crores and more. But it's not shared with anyone other than those banks. It's not allowed to share. It's not allowed to be shared even with the credit rating agencies. Right. a few days back, one of the professor in the IIM wanted my help to reach out to a bank, a housing finance company, to provide housing related data in a completely sort of masked manner without individual identification, because he wanted to study the pattern of housing in the country, housing development, and the loans contribution there too. I reached out to a couple of housing companies. All of them flatly refused to share. They said, we want to do it, but there is so much competition going on in the market. SBI has put out an advertisement in the paper that anybody who is a housing loan borrower from this company can come to us. We'll take that loan at half percent less. So there is so much competition on the credit side that the kind of databases, open databases, shared databases, are going to be extremely difficult.
Yeah.
It's not to say that it's not desirable. It's not to say it cannot be done. It should be done, but it would perhaps require an enormous amount of application of mind that it doesn't confer any extra advantage to your competitor, to somebody else. And if we can work that out, possibly this would be shared. Otherwise, credit would be the way the neobanks are doing. You generate fresh sort of data to assess the credit. I don't think you can get it from somewhere else to lessen your burden or reduce your hard work.
Then we rely on social media data to fill in the blanks.
And you said rightly, we also have those threats about the personal data regulation, protection. The laws on that side is still not clear. There are issues, that's why it's not moving. So that's a difficult space to deal with.
Thank you.
Mr. Ajit, after your presentation, Mr. Garg has spoken as well as the panelists have spoken. Do you have any observations or comments to make before I open it to the audience?
Sir,
I think there was another question.
Sir, I wanted to raise a question to you, sir. Sir, while it was very encouraging to understand there's a huge headroom on the credit side because the banks are flushed with funds, and if they do not lend, it may eat away their current balance sheet. Sir, while like for PayPoint India, we are a large BC network and we run a wallet company, and we are fairly, a decade-old company. So, when we approach the same PSU banks, the large banks, for a co-lending partnership, there is lots of resistance, sir. Sir, I'm just seeking your view. What do you feel over a period of time? How easy it will be to open up a relationship with the bank on the lending side, because they have the balance sheet and we have the reach?
I think that is the challenge right now. So I think some of the success stories that we see from some of what you call neobanks are ones that are partnering with banks other than the public sector, the main public sector banks. So, but eventually when you start watching models succeed in the private sector or with the small finance banks, then automatically the public sector banks would think it's more acceptable. Someone in the government, I think, is more risk averse, and particularly in a public sector bank, after all the excessive lending and the NPAs of the sort of loans made in the 2010-11 vintage, when credit was growing at 37-38% of that vintage, they are very risk averse right now. So part of the reason why they're not lending money is this entire risk aversion. Of course, the rest is this reset, all of that. But I think that they will come. The pressure on the banks to lend, you've had the finance minister on multiple occasions trying to instruct the banks to lend, But it's not going to happen because of an instruction. It has to happen because they're real loans that qualify based on processes that are instituted in these banks. And if they are not able to change their internal processes, I think they will start looking at sources outside that can help them, that they can partner with, where some of the risk is shifted on. So models, when you collateralize certain loans, sometimes the first loss can be with the entity. You have a smaller capital base. So if the first loss of a certain amount is taken by whoever is passing on this loan, but those models haven't evolved yet. The banking system in India is still not sufficiently evolved to use that model. But if something like that happens, like a first loss guarantee of the Neobank on certain loans, then you can start rotating your balance sheet, significantly faster. The other point I wanted to make that's related, I think, to the discussion that just was happening shortly prior, especially when we look at the account aggregator model, which, yes, certainly has to get sorted out right now. But what I would point to in the sharing of data, we have our Indian jugaad, where if it's cheaper to steal someone else's customer, why go and get one in terms of customer acquisition paying? So that kind of, desi jugaad that we're doing in many industries and many places, which makes global models fail. The one thing I point to is that the scoring model, which the Experian, Equifax, your TransUnion Sybil, which is the largest of them, is using, is actually based on the common good, right? So which is everyone that is giving their data, these guys are collecting it. It's an economic incentive for these three companies. So what's different between the account aggregator, the India stack, and the account aggregator model, when you look at it, the iSpirit model, is that there's no immediate financial incentive for that entity, right? It's the model right now is, so what we have to work out is if it's working for TransUnion, for Equifax, Experian, it has the same challenge, right? It has the challenge that all your competitors are looking at who has the loan as well. But if everybody else is part of that network and getting visibility to that data, and you don't join that network, then you're limiting yourself to the customers that approach you. So that public goods, the commons, there's the tragedy of the commons. Yes, too many people on it, all of that. But there's also the value of the commons, where if everyone shares and works together, that there's benefit that can get, be gotten out of it. So we have to study. We have to study whether the homegrown model, which is different from the traditional scoring model, but will have much richer data, because that data is not available. Not all of that data that we want to get access to, GST, all of that is available to the scoring companies. They basically might be Indian subsidiaries, but they're still foreign companies. That level of comfort of what the government is willing to share between different arms of the government itself. Income tax data, for example, revenue data is not shared with the rest of the government as well. So a lot of these things you've got to work out, but the faster we work it out from a policy perspective, the better it is. But also, unless the demand is being made by the private sector in sufficient volume, and the pressure is not on the government to start responding to that, to unifying that, it won't happen. I can tell you that the government is always lagging, because the number of possibilities are infinitely greater than what the government can deal with. The government is going to go for the lowest common multiple or highest common factor, depending on your perspective. And the regulator is even one step, further behind, more risk averse. So once it evolves, once they see this, a regulator is not going to be able to look at the universe of possibilities all over and have a solution that's well designed, because the main reason is to make sure that the need is being serviced by whatever that the new industry that is getting spawned is. It is ensuring that the stability of the system is intact. It is making sure that, depending on what kind of regulator it is, we also have, regulators like the Competition Commission. We have other regulators in India as well, outside the RBI, that could potentially get involved if there are huge distortions in the market. But regulators are usually trailing. If you look at the Competition Commission, it's not going to be entering before there's a competitive situation developing, when there's, huge up the S-curve of penetration, all of that. So that would be my sort of two bits. I'm not saying that the account aggregator model is free of issues, but what I'm saying is that we have examples that are existing in the world that are doing very well, are growing, are replacing in terms of market share the credit rating agencies, whose credibility is getting questioned each time we have an ILFS or we have one of these things. So we do have these new models, and I think that what the the neobanks or the morphing entities, what could be a banking correspondent in the past, what could be a fintech, all of that to Subhashji's point, they are getting a stream of data themselves. These payment banks start as payment banks because you can't get into credit immediately. But as you get the stream of data yourself, you have something that's saleable. You have a reason why the banks would want to be piggybacking off you. So if you're an early leader with sufficient market share and you want to open an account, if you go to a bank, a smaller bank, Dr. Charan Singh was the chairman of Punjab and Sindh Bank. So if Punjab and Sindh Bank has limited footprint in terms of number of branches out of the public sectors, it has the fewest, I think, right? If I'm not mistaken, either number 11 or number 12 now after the newly consolidated banks. So if they have limited reach, but they have national ambitions, rather than set up brick and mortar, why would they not be open to meeting and speaking with someone that has data, track data, payment information of 40 million accounts or even 5 million accounts when their accounts are limited and they're looking? So I think you will find people open. They're probably looking for some other public sector bank to take the risk first. SBI is an early sort of leader when you look at cash flow based lending, things like that. They're willing, as a big bank, it's a small risk for them when they take that. But I think you will start seeing, as you find early leaders in the public sector, you will find a lot of followers because it makes a lot of sense. The complementariness of these two, especially in the new model, is fairly high. I hope that addresses your question.
Yes, sir. In fact, we are willing to chip in the risk side by giving a margin and taking a pie of the risk. But we are yet to see the opening, sir. I am sure, as you say, it is going to happen sometime. Thank you, sir. Thanks a lot.
There are a few questions in the chat box. I was wondering if any one of the guest speakers would like to take that. I can read it out for you. One is by Dr. Manmeet saying, I think financial inclusion concept is taken care by neobanks. These banks are including teenagers in the banking. These banks are offering their savings account with zero balance with the technology. These banks making their customers at an early stage. That is one. Then there is another one from Charu Sheila. One of the article, it was written that in India, around 85 to 90% of the population doesn't have bank account. Then how will neo-banking help encouraging to open bank account and get digital education? There's another one by Charu Sheila Shah. Even if the regulations would be made on this neo-banking or digital one, do you think the scam happens or any bank gets closed in future? And who will be answering or paying back to the customers who loses this money from the above said problem? Any one of the guests would like to take it?
So Charanji, we already addressed, I think, Charushila's question. When
Yes.
we talked about the 420 million Jan Dhan accounts, the
Yes.
definition, by definition, a Jan Dhan account is opened only for someone that doesn't have another bank account.
Right.
So the Jan Dhan account itself will disprove that article, which talks about 85 to 90% of the population not having bank account, because just the Jan Dhan accounts, forget about what pre-existed in the banking system, is about a third of the population.
Yes.
So that would mean that there's only about 70% that would be left for the regular bank accounts that already pre-existed. Unfortunately, because of a technicality or the court stepping in, judicial intervention, we cannot determine the exact number of people outside of Jan Dhan that have bank accounts because we don't know how many people have multiple bank accounts as a country. We can't filter out that to see how many of the other families have. So even for Jan Dhan, it's very difficult for us to get the total penetration. Today, if someone had to ask us, is the Jan Dhan program saturated? It is difficult for us to tell because the non-Jan Dhan accounts, we don't know how many people have 2, 3, 4 accounts because banks don't have to share with other banks whether they have your account or not. So there are ways not every single account is able to discern, that difference. But I think we've addressed these other questions of hers, with, just that now piece of
yes.
I
Mr.
don't
Garg,
think having a bank account is a problem in the country. What perhaps she might have missed, I'm just guessing, is that in India, 80 to 85% persons have bank accounts. It's not that they don't have bank accounts. It might be only very few who are left. So I don't think that's an issue.
Right. So I have one final question probably. Right. So
Yeah,
where do you see this neobank space evolving in the next 5 years? Are you betting on the fintech companies to come up with innovative ideas and either use the existing financial institutions guardrails to bring about new solutions? Are you or will you be betting on traditional banks to step up their game in the neobanking space?
I would go to both the guests and they would know better. I would start with Mr. Garg first.
See, I see the fintech companies evolving into the new banks. We can call them credit fintechs also. So, so that is the space which is, unless, of course, the Reserve Bank takes a major step forward and bring some approach paper for digital banking in the country. The second space to my mind where this would sort of see some action is what we call non-banks today. So there are several, and the Reserve Bank there has permitted some non-banks to be digital only non-banks. So that space should also bring the new bank kind of concept to do it. I see promise in technology enormously, and especially on the decentralized blockchain technology, where you can sort of match the assets and liabilities, raise funds, which match the maturity of the credit side, etc. There's tremendous possibilities of the smart contracts in a way executing those in an autonomous manner. So that space is very promising, and that's where I think it will come. Let's see. That's my take.
Ajit.
So I think that the models that are going to evolve are going to depend on what the sort of competitive action is taken by the incumbents. So the incumbents right now, I regard them not just as the scheduled commercial banks, but also some of the NBFCs that are retooling right now. And when we look at the new models, it's because both of the prior models were facing challenges, the challenges that we talked about. But I think there are other sort of channels that can start opening up right now. For example, one of the very interesting findings over the past 16 months since the pandemic began, it might be interesting for people in the fintech industry to know that the number of CDSL and NDSL accounts that have opened for trading have more than doubled in the country. So these are people that are looking at investments. And a large part of that might be driven by formalization of the economy. When people enter the formal system, they were missing out on a lot of growth of equity. Equity by far is the fastest growing asset class in terms of returns, very high risk. And we know we are in a very risk averse country right now. As a country, and especially a system, we are risk averse. But the highest returns are in equity. And in the past 16 months, the number of these accounts have doubled, right? In the past 2 years, let's say. Now, why is this happening? As you enter the formal system, as you're looking at all of this, you're watching these channels. Now, are there people that are, when you're looking at a bundle of services, is there anything that prevents some of these fintechs to become asset management advisors? It's a license. I mean, there is a license, but it's a very easy to get license. You're already collecting assets as an advisor because you have your name attached, you know who's got the money. It's not a bank. It's not, you do have asset manager in the banks, but there are many, many channels that could evolve. So the reason why I mentioned some of these new channels is that, like you've talked about when we started out in this discussion, you talked about different strategies for different neobanks, depending on where they're coming from. Someone has good exposure to the auto market. Someone has good exposure to the consumer finance market. Someone has good exposure to certain kinds of MSMEs. That channel will dictate the strategies. But once you become big enough, the fact is that the NBFC itself will have to evolve its strategy, right? Or the Neobank will have to evolve its strategy. Rather than piggybacking off one bank, you might start piggybacking off multiple banks, in terms of your dealings and what you do. Whether you're a service agency or whether you're taking a percentage of the risk is another. If you're just an intermediary that it's flow through, you make a transaction fee and it's gone, or whether you're going to take a percentage of the risk and get a return. Now, all of these things are going to be evolving as I think these models evolve. But if I were a venture capitalist investing in models, I would probably be betting on many, many different models, but just going for the best player that I saw in each model, where they're coming from, who's got the best strategy. And the one thing I'd also put in is the Darwinian analogy. It's not the smartest that survive. It's not the strongest or the fastest. It's the ones that are most adaptable to change. So we saw regulations change on transaction fee just about a year and a half ago, and suddenly a business model of the India Post and Payments Bank that hadn't even started was had zero revenue overnight, right? So then how does that model adapt? And that adaptability in an environment where things are growing as rapidly as they are right now, in a new space where we know that regulation will follow, we know that government rules will follow, the changes will be unexpected, and the way the growth will come is unexpected. So I would diversify. If I were investing in this market and I had to take a bet, I would take both bets, and in fact, I would take additional models as well. So to diversify that basket. I hope that addresses your question.
Yeah, it does. Thank you so much.
We have come to an end. It is 5:10 already, and I would now like to conclude by thanking the panelists, thanking Mr. Ajit Pai, our special guest for the day, and thanking Mr. Subhash Chandra Garg, our chief guest for the day. We have had a very healthy discussion. Various aspects have been explored. It's very futuristic that we are thinking about. My own personal view is fintech will take ahead, and brick and mortar branches are bound to shrink, and fintech is going to bring in a sort of revolution. If I look 25 years back, where was Indian banking? And I look at India 46, 47, where would be Indian banking? I see, obviously, technology will come in a very big way and change the contours of banking, not only in India, but also abroad. As it is, we are already in the midst of technological revolution. One could never imagine transactions of the variety of YONO that are taking place in our country. And the Jam Trinity has already made it for us to imagine, possible for us to imagine that technology is the way ahead. As the chief guest mentioned in his address, is it the credit side that we are going to focus on? The deposit side to some extent, yes. Is it the credit side? I think it's going to change tremendously. Which sectors, what factors, whatever said and done, my sense of today's discussion is that technology is something we are looking forward to in the next 15, 20, 25 years from now. With that, let me also thank all the participants who've been staying with us for nearly 2.5 hours today, asking their questions and patiently listening to the rich discussion that happened here today. I would like to thank ASSOCHAM for bringing such an issue up and arranging such an excellent discussion. Dr. Rajesh leads the team at ASSOCHAM, and I would like to thank him for this. With that, all the best. Looking forward to next interaction, and I would now like to conclude the session here. Thank you very much.
Thank you very much.
Thank you. Thank you to all.
Thank you.
Thank you.
Thanks, everyone.
Thank you.
Thank you.